Okay, so welcome back guys to lecture 6 of our 2025 mentorship series. Today we are going to be looking at a crucial concept or theory, time and price. So we are going to be looking at how to encapsulate time to your trading. So time and price theory is a trading concept which is most associated with price movements in the financial markets being linked to specific times. So combining these two factors, price and time, provides a more complete understanding of future market predictions, or like it gives you an insight about what the market will do at a given time. So it helps you to anticipate moves before they can happen. It involves analyzing when certain price movements like reversals, trends, or certain price action will occur. Like suppose we have sessions, we have macros, we also have economic events that happen at a given time. Rather than focusing on price action in isolation, if you add time and price to your trading, you have prior knowledge, or you have an advanced thinking about what the market will do at certain times before it does it. Now I want us to look at the key aspects in this theory of time and price. So we have one, interconnectedness of time and price. So the core idea is that time and price are not independent but work together. So you have to link these two as one. You have to know that they work together, or you have to use them together, in that you can create a model of your own or formulate a specific system for your trading, and these help you to create high probability trade opportunities, so you can get a chance of making better decisions if you add time to your trading. And another key aspect is noticing the market structure cycles, so you can get to know if you add time and price. As I told you about situational analysis, where you can look at what happened in the market, or what usually occurs in the market, to formulate a base model for your own. So these time and price concepts can help you, like the time and price theory can help you formulate that, knowing that if you are in situational analysis, you're going to look at if Friday's high is not higher than Thursday's high, you're going to be looking at Friday's lows as a draw on liquidity. So things like that, you need to have time in your trading. So you have to also, another key aspect of time, the trading sessions. You have to know, I'm going to be talking deeply about the sessions in different videos, so we shall have every session with a video on its own and how to deal with it and the timestamps that are in it. So suppose the sessions, we have the Asian session, we have the London session, we have the New York AM and PM session, or the New York AM can be categorized with the pre-market session and the 9:30 open or opening bell to 5. Sorry, is it 5? Yeah, to 11. So you have to know everything about that. And also the PM session can also be categorized as from 1:30. Then we have the 2 PM like AMD models, things like that. So you have to have prior knowledge about the trading sessions. Then also we need to get to learn or to gain experience about predicting market movements. So if you get this time, you will know how to predict when certain movements are going to happen. So when after we learn time, we shall have to incorporate technical analysis with it. So everything we've been studying, the fair value. I don't know whether I was being heard. I see my microphone was off. But I'm sorry. As I was saying, for everything you do, you need to be having different things you're looking at that will enable you to take a trade. So the market operates in accordance to time, whether in fundamentals or in technical. So even there is no news that is going to be released without further allocation of its time. So nothing will happen at random in the market. We have various key times of the day at which specific ones are anticipated to happen. So there are specific times we expect things to happen in the market. So we have we have sessions, we have macros, we have market openings. So, and if you tend to analyze and look at when the economic news calendar events are released, they are mostly released at openings or macro times at specific times. So sessions will have the Asian session, as I had said, we have the London session, we have the New York AM and PM session. Then I will be talking about each one of them in separation. So we also have macros. Now every hour in the day has a macro, and a macro refers to, okay, if I'm to talk up something about macros, we have every macro in the day has, every hour has a 20-minute time window from the previous hour to the current hour. So if you are to divide that into two, you're going to have 10 minutes at the end of that hour, then to 10 minutes at the beginning of that hour. So that's your macro. You understand? Apart from those macros of the PM session, they tend to differ or vary, but we shall be looking at that. Then we have opening and closing bells. So at the New York Stock Exchange, there is a certain time where the trading starts, the real trading, the working. So at 9:30 at the New York Stock Exchange, the opening bell is rung to mark the start of the day's trading session, and at 4 p.m. the closing bell is rung to mark the closure of the day's trading session, and that's when we have the closure of that day's trading also on our charts. Now if you follow that time, you can also use that to formulate your daily profile starting at 9:30, not at the market open. And mostly this is regular trading hours open the 9:30, and then this is its close for the regular trading hours. I'll be looking at that. We have two trading hours. We have electronic trading hours and regular trading hours. So at 4 p.m. they all close, and then we open up at 9:30, but for electronic trading hours we open up at 6. Then we have, for market openings, we have opening ranges. So an opening range is how can I say this? These are price ranges formed from highs and lows of the initial minutes of a trading session. Mostly it is 30 minutes. I would like to consider 30 minutes because it gives you a lot to deal with. So you can have a lot to work with. if you consider the 30-minute opening ranges. Some people consider 15, but I like the 30 minutes most, like from 9:30 to 10 a.m. So that's a 30-minute time window that I can use, dividing quadrants of it, and then looking at price action and how the market reacts to each significant level in that opening range. Then, so this is, if I'm to briefly talk about opening ranges, this is a short-term equilibrium between sellers and buyers, and it indicates market sentiment for a given session. So if you are to trade a given session, you mostly look at the opening ranges, and it will give you what the market makers are trying to do in that given session. Matter of the fact, I will be teaching mostly scalping, not long-term trading, because I think one can work better with, if you are to become a day trader, like typical day trader, and it is your main source of income. So most of the time scalping is better. So I have two opening ranges I look at. I have the 12 to 12:30 opening range, and I use that a lot. For the 12 to 12:30 p.m. opening range, and then there is the 9:30 to 10 a.m. opening range. So those two, I use them a lot, and they provide significant price action and market sentiment. So with that, I don't think this video should be that long, because this is an introduction to time and price. We shall be looking at the sessions, then we shall look at the daily profile and the weekly profile. Okay, all together will be the accumulation manipulation mode. Okay, how the day has to move by default. Then we shall be looking at the macros, each at a time. Then I think after that we shall start using live recordings. We shall be doing live trades and executions, I think. So thank you for watching. Like and subscribe.